Trading development is often perceived as a straightforward journey where increased knowledge and experience naturally lead to better results. Many assume that the more time spent in the market, the more skilled a trader becomes. However, this view oversimplifies the reality. In practice, trading development follows a series of distinct stages, each defined not just by what a trader knows, but by how they think, behave, and make decisions. Progress is not simply about learning more information. It is about transitioning from one stage to another through structured and deliberate change. Each stage represents a different relationship with the market. In the early stages, the focus is often on exploration. There is curiosity, excitement, and a desire to understand how price moves. Traders experiment with different strategies, indicators, and approaches, often without a clear framework. This stage is valuable because it builds initial exposure, but it is also where many habits are formed, both good and bad. As development continues, later stages begin to emphasize structure, discipline, and consistency. The focus shifts from trying everything to refining a specific approach and executing it with precision. The transition between these stages is not automatic. Time alone does not guarantee progress. A trader can spend years in the market without moving beyond the same stage if there is no conscious effort to improve behavior and decision-making. Progress requires awareness, an understanding of current habits and limitations, as well as adaptation, which involves making specific changes to address those weaknesses. Without deliberate effort, it is easy to remain stuck, repeating the same patterns while expecting different results. One of the most significant challenges in this process is accurately identifying one's current stage. Many traders believe they are progressing simply because they are more active or have gained more exposure to the market. They may be taking more trades, analyzing more charts, or trying more strategies. While this can create the feeling of growth, it does not necessarily indicate real improvement. True progress is reflected in consistency, consistent execution, consistent risk management, and consistent adherence to a defined process. Without these elements, increased activity often leads to increased mistakes rather than advancement. This misidentification creates an illusion of growth. A trader may feel more confident or knowledgeable, but if their behavior remains inconsistent, they are still operating within the same stage. This can be particularly frustrating because it leads to a cycle of effort without meaningful results. The trader believes progress is being made, yet performance does not reflect that belief. Breaking this cycle requires a shift in focus from activity to quality, specifically, the quality of decisions and the consistency of execution. It is also important to understand that stages are not defined by profit alone. Profitability can be misleading, especially in the short term. A trader in an early stage may experience a series of profitable trades due to favorable market conditions or luck. However, if those trades are based on inconsistent behavior or lack a defined process, the profitability is not sustainable. On the other hand, a trader in a more advanced stage may experience losses while refining a structured system. In this case, the losses are part of the development process and may lead to long-term improvement. This distinction highlights why focusing solely on outcomes can lead to incorrect conclusions about progress. Recognizing trading stages requires objective evaluation. This involves analyzing how decisions are made rather than just looking at results. Key areas to evaluate include decision-making patterns, such as whether trades are taken based on clear criteria or impulse, risk management practices, including consistency in position sizing and stop-loss placement and adherence to a defined strategy. By examining these factors, a clearer picture emerges of where a trader stands in their development. This level of evaluation removes guesswork and provides a more accurate assessment of progress. The purpose of identifying stages is not to label or judge performance, but to provide direction. Each stage has its own set of challenges and requirements for progression. For example, early stages may require developing basic understanding and reducing impulsive behavior, while later stages focus on refining execution and maintaining discipline under pressure. By understanding the current stage, it becomes possible to focus on the specific improvements needed to move forward. This targeted approach is far more effective than trying to improve everything at once. Ultimately, the key principle is that trading development is structured. It does not happen randomly or automatically over time. Progress occurs through clear transitions, where one set of behaviors is replaced by a more refined and disciplined approach. Each stage builds on the previous one, creating a foundation for long-term consistency and performance. By understanding this structure, trading becomes less about chasing quick results and more about building a process. It encourages patience, self-awareness, and a commitment to continuous improvement. Instead of feeling stuck or uncertain, a trader gains clarity on where they are and what needs to be done next. This perspective transforms trading from a confusing and often frustrating experience into a more organized and purposeful journey. Development becomes intentional rather than accidental, and progress becomes measurable through behavior rather than outcomes. In the long run, this structured approach is what leads to true advancement and sustainable success in the market. The early stage of trading is defined by exploration and unstructured learning. This is where most traders begin their journey, driven by curiosity and the desire to understand how markets operate. At this point, everything is new. Charts, indicators, price movements, and strategies all seem full of potential. There is a strong motivation to learn, but the learning process is often scattered and inconsistent. Instead of following a clear path, knowledge is gathered from multiple sources, leading to a fragmented understanding of the market. In this stage, decision-making is heavily influenced by external information. Traders tend to rely on indicators, signals, social opinions, or strategies found online without fully understanding how or why they work. A setup may appear convincing simply because it has been recommended, or because it worked in a previous instance. However, without a deeper understanding of the underlying logic, these decisions lack consistency. Trades are often based on partial information or surface-level patterns, which leads to unpredictable results. One trade may succeed, while the next fails under similar conditions, creating confusion and uncertainty. Emotional responses play a significant role during this phase. Because there is no structured framework to guide decisions, outcomes are interpreted on a personal level. A profitable trade can quickly lead to overconfidence, creating the belief that success has been achieved. This may result in taking larger risks or increasing trade frequency without proper justification. On the other hand, a series of losses can lead to frustration, doubt, and even hesitation to take valid opportunities. These emotional swings create instability, making it difficult to maintain any form of consistency in behavior. Risk management is another area where inconsistency is common in the early stage. Position sizes are often adjusted based on confidence rather than a defined rule. A trade that feels right may be given more capital, while a less certain setup may receive less attention. Stop-loss levels, if used at all, are frequently moved or ignored when the trade goes against expectations. This behavior exposes the account to unnecessary risk and can result in losses that exceed acceptable limits. Without a structured approach to risk, even a few mistakes can have a significant impact. One of the most defining characteristics of this stage is the search for a perfect strategy. There is a strong belief that somewhere there exists a system, indicator, or combination of tools that can eliminate losses and produce consistent profits. This belief leads to constant switching between strategies. A trader may try one method for a short period, abandon it after a few losses, and move on to another approach. This cycle repeats continuously, preventing any real understanding or consistency from developing. Instead of refining a single method, the focus remains on finding something new. Despite these challenges, the early stage is not without value. It serves as a foundation for future development. During this phase, traders are exposed to key concepts such as market structure, price behavior, and basic technical tools. They begin to recognize patterns, understand how markets react under different conditions, and gain familiarity with the trading environment. This experience is essential, as it builds the initial awareness needed for more advanced development. However, the primary objective in this stage should not be profitability. Focusing on profits too early often leads to frustration and unrealistic expectations. Instead, the goal should be understanding how decisions are made, how markets move, and how different approaches perform over time. By shifting the focus to learning rather than earning, the pressure is reduced, and the foundation becomes stronger. Progression from this stage requires a deliberate shift from exploration to structure. At some point, it becomes necessary to stop searching for endless strategies and begin selecting a specific approach. This approach should then be developed into a set of clear rules that define how trades are identified, executed, and managed. This transition marks the beginning of structured trading, where decisions are based on predefined criteria rather than impulse or external influence. Without this shift, traders often remain stuck in a cycle of unstructured learning. They continue to explore without ever building consistency, repeating the same mistakes while expecting different results. Breaking out of this cycle requires commitment to a single method and a willingness to refine it over time. In summary, the early stage of trading is a period of discovery, experimentation, and learning. While it is often marked by inconsistency and emotional decision-making, it also provides the essential groundwork for future progress. By recognizing the limitations of this stage and making the transition toward structure, traders can begin to move toward a more disciplined and consistent approach. The intermediate stage of trading represents a critical transition point between unstructured exploration and professional-level execution. At this stage, a trader has moved beyond random experimentation and has begun to develop a more defined approach. There is usually a clear strategy in place, along with a basic understanding of risk management principles. However, despite this progress, one major challenge remains consistency. This is the stage where many traders feel they are close to success, yet continue to struggle with unstable results. A key characteristic of this stage is that rules exist, but they are not followed consistently. The trader knows what conditions should be met before entering a trade, understands where to place stop losses, and has a general plan for execution. However, in practice, these rules are often bent or ignored. Trades may be taken outside of the defined criteria, sometimes due to the influence of recent outcomes or emotional responses. For example, after a series of losses, there may be a temptation to take a trade that does not fully meet the setup, hoping to recover quickly. After a series of wins, overconfidence may lead to relaxed standards. This inconsistency creates variability in performance, making it difficult to achieve stable results. One important development in this stage is increased awareness. Unlike the early stage, where mistakes often go unnoticed, traders at the intermediate level can usually recognize when they have deviated from their plan. They are able to look back at a trade and identify what went wrong, whether it was an early entry, a missed confirmation, or a violation of risk management rules. This awareness is a significant step forward, as it shows a growing understanding of the process. However, awareness alone is not enough. The challenge lies in preventing these mistakes in real time. Knowing what should be done and actually doing it are two different things, and bridging this gap is the core task of this stage. Risk management also shows improvement, but it is still inconsistent. Traders in this stage typically have defined rules regarding position sizing, stop loss placement, and acceptable risk levels. However, these rules are not always respected. There may be periods where risk is controlled effectively, followed by moments where it is adjusted impulsively. For instance, a trader might increase position size after a loss in an attempt to recover more quickly, or move a stop loss further away to avoid taking a loss. These actions disrupt the stability of the system and lead to uneven results. As a result, periods of steady performance are often followed by drawdowns that erase previous gains. This inconsistency is reflected in overall performance. Traders in the intermediate stage often experience cycles of profitability and loss. There may be weeks or even months where results are positive, creating the impression that the strategy is working. However, these gains are often offset by periods of poor execution, where discipline breaks down and losses accumulate. This fluctuation creates uncertainty and can lead to frustration. The trader may begin to question whether the strategy itself is effective, even though the real issue lies in inconsistent execution rather than the method being used. Because of this uncertainty, there is often a temptation to change strategies frequently. When performance declines, it can feel logical to assume that the system is flawed and needs to be replaced. However, in most cases, the problem is not the strategy, but the inability to follow it consistently. Constantly switching approaches resets the learning process and prevents the development of mastery. Instead of refining one method, the trader returns to a cycle of exploration, similar to the early stage. This delays progress and reinforces inconsistency. The focus during the intermediate stage should shift away from strategy development and toward execution. The objective is not to find a better system, but to apply the existing one with greater precision and discipline. This requires a commitment to following rules exactly as they are defined, without adjustment based on emotion or recent outcomes. By doing so, the trader can begin to generate consistent data, which is essential for evaluating performance accurately. Tracking and analysis become especially important at this stage. Maintaining a detailed trading journal allows each trade to be recorded along with the reasoning behind it and whether it followed the plan. Regular review of this journal helps identify patterns of behavior, particularly recurring mistakes. For example, a trader may notice a tendency to enter trades too early or to deviate from risk parameters after losses. By identifying these patterns, targeted adjustments can be made to improve consistency. Progression to the next stage is defined by discipline, the ability to follow rules without deviation, regardless of emotional pressure or recent performance, is what separates intermediate traders from advanced ones. This transition is often the most challenging part of the trading journey because it requires changing deeply ingrained habits. It demands patience, self-control, and a willingness to prioritize process over immediate results. In summary, the intermediate stage is where structure is established but not yet mastered. The trader has the tools and knowledge needed for success but struggles to apply them consistently. By focusing on execution, maintaining accountability, and reinforcing discipline, it becomes possible to move beyond this stage. This transition is not easy, but it is essential for achieving long-term stability and success in trading. The advanced stage of trading represents a significant shift in perspective and behavior. At this level, the focus is no longer on individual trades or short-term outcomes, but on the overall process. Trading becomes less about reacting to market movements and more about executing a well-defined system with consistency and discipline. This transition marks the point where trading begins to resemble a structured professional activity rather than a series of isolated decisions. One of the defining characteristics of this stage is consistent execution. A clear trading plan is not only in place, but is followed with precision. Every aspect of the process, entries, exits, and risk management, is predefined and applied without deviation. Decisions are no longer influenced by momentary emotions or recent outcomes. Instead, they are guided by rules that have been tested and refined over time. This consistency creates a stable framework, allowing performance to be evaluated accurately and improved systematically. At this level, emotional influence is significantly reduced. Emotions do not disappear entirely, as they are a natural part of human behavior, but they no longer dictate decisions. A trader in the advanced stage is aware of emotional responses such as fear or excitement, but does not act on them impulsively. Instead, decisions are made objectively, based on the criteria defined in the trading plan. This ability to separate emotion from action is a key factor in achieving consistency. It allows the trader to remain focused on the process even during periods of uncertainty or drawdown. Risk management becomes fully controlled and integrated into the system. Position sizes are consistent and based on predefined rules rather than confidence or external factors. Stop-loss levels are respected without adjustment, and overall exposure is managed carefully. This disciplined approach to risk ensures that losses remain within acceptable limits. As a result, significant drawdowns are avoided, and the account is protected over the long term. The focus shifts from trying to maximize gains to maintaining stability and preserving capital. Performance in the advanced stage becomes more stable as a direct result of this consistency. Losses are no longer viewed as failures but as expected outcomes within a probabilistic system. Each trade is part of a larger series, and individual results are less significant than the overall pattern. Gains and losses are evaluated based on the quality of execution rather than the outcome itself. A well-executed losing trade is considered successful because it adheres to the plan, while a profitable trade that violates the rules is seen as a mistake. This shift in evaluation reinforces disciplined behavior and supports long-term improvement. Another important aspect of the advanced stage is the focus on continuous improvement. Even with a stable system in place, there is always room for refinement. Performance data is regularly reviewed to identify areas for enhancement. This may involve adjusting entry criteria, refining exit strategies, or improving risk management techniques. However, these adjustments are made carefully and based on sufficient data, not on short-term results or emotional reactions. The goal is to enhance the system while maintaining the consistency that has already been achieved. It is important to understand that the advanced stage is not defined by perfection. Losses still occur, and challenges still arise. The difference lies in how these situations are managed. Control becomes the defining factor. The ability to follow rules consistently, manage risk effectively, and maintain objectivity under pressure is what distinguishes this stage. Perfection is neither realistic nor necessary. Consistency and discipline are what drive long-term success. At this level, trading becomes more predictable, not in terms of market direction, but in terms of behavior and performance. The trader knows how they will respond to different scenarios, because those responses are defined in advance. This reduces uncertainty and increases confidence, not because outcomes are guaranteed, but because the process is reliable. Progression beyond the advanced stage involves further refinement and adaptation. With a strong foundation of discipline and structure, it becomes possible to explore more advanced techniques and strategies. These may include optimizing performance under different market conditions, improving efficiency, or integrating additional tools to enhance decision-making. However, these advancements are built on the existing framework rather than replacing it. In summary, the advanced stage represents the transition from inconsistent effort to controlled execution. The focus on process over outcomes, combined with disciplined risk management and continuous improvement, creates a stable and sustainable approach to trading. This stage is not about achieving flawless results, but about maintaining control over behavior and decisions. Ultimately, this level of development allows trading to evolve into a professional practice. The trader is no longer reacting to the market, but operating within a structured system that supports consistent performance. This is the foundation for long-term success and the platform from which further growth can occur. The professional stage represents the highest level of trading development, where all foundational elements, discipline, structure, consistency, and self-awareness, are fully integrated into a sustainable approach. At this stage, trading is no longer driven by the pursuit of quick results or isolated opportunities. Instead, it is approached as a long-term process, where every decision is aligned with a broader system designed for stability and continuous performance. One of the defining characteristics of the professional stage is the shift in perspective from individual trades to the overall system. Each trade is no longer seen as a standalone event that must succeed, but as one instance within a larger series of outcomes. This perspective removes the emotional weight from any single decision and allows for consistent execution. Performance is evaluated over time, based on how well the system is followed rather than on short-term gains or losses. This long-term view creates a stable mindset, where fluctuations are expected and managed rather than feared. Adaptability becomes a critical skill at this level. Markets are constantly evolving, influenced by changes in participation, technology, and global conditions. A strategy that performs well today may become less effective over time if conditions shift. However, adaptation in the professional stage is not reactive or impulsive. Adjustments are made based on data, observation, and structured analysis. This ensures that changes improve the system rather than disrupt it. The ability to refine strategies while maintaining consistency is what allows performance to be sustained over the long term. Risk management remains the foundation of this stage, but it is applied with even greater precision and awareness. The primary objective is no longer maximizing returns but preserving capital. This mindset ensures longevity, allowing the trader to remain active in the market regardless of short-term outcomes. Every decision is made with risk in mind, and exposure is controlled carefully. Drawdowns are minimized, and recovery is managed within the structure of the system. This focus on capital preservation creates a stable base from which consistent performance can be achieved. Emotional stability is another defining feature of the professional stage. While emotions are still present, they no longer influence decision-making. Confidence is not based on recent results but on trust in the system. External factors such as market noise or short-term volatility have little impact on behavior. Decisions are made logically, following predefined rules and structured analysis. This level of control allows for clear thinking even in uncertain conditions, reducing the likelihood of impulsive actions. Efficiency also improves significantly at this level. The trading process becomes streamlined, with unnecessary actions and distractions removed. There is no longer a need to constantly search for new strategies or overanalyze the market. Instead, the focus is on executing a proven system with precision. Time and energy are directed toward high-quality decisions rather than excessive activity. This efficiency not only improves performance but also reduces mental fatigue, making it easier to maintain consistency over long periods. Continuous learning remains an essential part of the professional stage. Even with a well-developed system, there is always room for refinement. Markets evolve, and maintaining an edge requires ongoing development. This includes reviewing performance data, studying changes in market behavior, and exploring new techniques that can enhance the existing framework. Learning at this stage is focused and purposeful, aimed at improving efficiency and adaptability, rather than starting from scratch. The ultimate objective of the professional stage is sustainability. Success is no longer measured by short-term profits, but by the ability to produce consistent results over time. This requires a balance between discipline and flexibility, discipline to follow the system consistently, and flexibility to adapt when necessary. Sustainability ensures that trading is not only profitable but also stable and repeatable, providing long-term viability. From a broader perspective, trading development can be understood as a structured progression through distinct stages. Each stage presents its own challenges and requires specific improvements. The early stage focuses on exploration, the intermediate stage on building structure, the advanced stage on achieving consistency, and the professional stage on maintaining and refining performance. Understanding these stages provides clarity and direction, making it easier to identify what needs to be improved at any given point. Misidentifying the current stage can lead to repeated mistakes and delayed progress. For example, attempting to optimize a strategy without first achieving consistent execution can create confusion and instability. Accurate self-assessment is therefore essential. It allows for targeted improvement, ensuring that effort is directed toward the areas that matter most. This structured roadmap highlights the path from initial curiosity to professional-level trading. It emphasizes that progress is not defined by how active a trader is or by short-term results, but by the development of consistent behavior and a reliable process. Each stage builds upon the previous one, creating a foundation for long-term success. The key principle remains clear and practical. Progress in trading is achieved through structured development and consistent execution. By focusing on the process, adapting with purpose, and maintaining discipline, it becomes possible to reach a level where performance is not only achievable but sustainable over time.